Okay, so once again, welcome everyone. My name is Maulik Shah, and I'm one of the co-founder and a CEO of Almas Risk Consulting. At Almas, we specialize in managing the key three financial risks, that's currency, commodity, and interest rates. And today's session is all about this FRM framework that we as a corporates are dealing with it almost on a daily basis. About the webisode, this is the series that we launched in April 2023, and today is the 10th monthly webisode series. The intention of the series is to, one, whatever we have, and I'm saying Almas as an entity, we collate a lot of informations, we research. The whole idea of this series is to spread this knowledge and in the process empower and enable all the market participants in their own decision making, ensuring that they get what we have. And this is our medium through which we spread. But I think the most important thing is what is really keeping us and keeping the whole momentum on is your participation. That every month you all come back, you participate, and that really gives us that encouragement, that that lift up to come back in the next month again. So we will be completing almost 12 series for the year, and we will have the new theme for the new financial year. But yes, one thing which I can assure you is that this will go on and this will continue. So thank you all once again for really taking your time out from your busy schedule, participating in this deliberations. It really, really means a lot. So thank you all very much. Today's session, as I mentioned earlier, is about the FRM framework, corporate risk management, very important for all the corporates. And I'm indeed pleasure. I'm really, I would say, joyful to have someone whom I had worked years back, who is an accomplished finance professional, well-wisher. He has been a speaker on the subject on number of platforms. I will take a few minutes to introduce him formally. But yes, for Almas and for me personally, he has been a great, a person to look up to when it comes to FRM, the financial risk management, and the profession that we are in. So he is a chartered accountant. He has been currently serving as a Group Chief Financial Officer at Blue Star since July 2022. And prior to this, he held very senior position in Mahindra Group. Before moving on to Blue Star, he was a Senior Vice President, Group Finance and Group Treasurer. And he has also acquired during his tenure in Mahindra, and it was a very long tenure, almost 20 years plus, where he participated in prestigious leadership program at IMD, Yale School of Management, and Harvard Business School between 2016 and 2018. He received a fellowship for leadership in management at Carnegie Mellon University, Tepper School of Business in 2013. And one thing which I can talk about is that his career really reflects a strong foundation in financial leadership. I've heard him at many platforms. He really speaks his heart out. He really is very straight. I would say blunt on some of the concepts and a lot to learn. So that's Nikhil Sohoni for us. Thank you very much, Nikhil, for joining us today from Dubai. He has been in Dubai for his business travel and been very kind enough to accept the invitation. Thank you, Nikhil.
Thank you, Maulik, for those generous words. And it's my pleasure to be here. And it's something really good to see Almus conducting these webisodes. I think there's nothing more good than sharing and learning. And therefore, it's always a pleasure to be part of this group. So
Thank you
thank you
so much.
for inviting me today.
Thank you, Nikhil. And with me, I have Pankaj Rathi, my partner, someone who heads the treasury, manages the entire operations, and he is an expert in money market, the forex market, uh, chartered accountant, CFA, and with almost 25 years plus experience. Uh, One thing between me and Pankaj, and this is about the format of today's session. I think one of the things we are just trying to bring in some kind of a different unique format. While on the picture on the flyer, you will see me as a moderator and both of them as a speaker. I want to keep it as a free flowing conversations. And with Nikhil, I have taken that liberty to create 2:1, which means that consider both me and Pankaj are going to be the moderator, and he is the one who is going to be spot on. So Pankaj will have his own set of questions. So as we progress in the session, while I will put few questions, Pankaj will also do that. And even Nikhil, you may have any questions, feel free to, put it up to. So the whole idea is it will be a free flowing conversations. And all of you, you can also use this opportunity to put across your thoughts in a chat box. You don't have to really wait for a Q&A session. Q&A session will be on the go. So anything, any questions you may have, just put it up. I'll pick it up from the chat box or a Q&A and then place it to the speakers. So that's really the format. It's 5:08.
So the format, Maulik, is I am on the firing line, and
That
the two
was the whole
experts from
objective.
that
You
side
picked
are
it up
firing at me.
well. So good. You picked it up well early. So you can now prepare yourself for. All right. So the session is all about financial risk management. And I'll just clarify once again, it's a currency, commodity, and interest rate risk management. Now, okay, we already have Q&A briefing up. The chat is disabled. Just check up. And the chat is disabled. So just enable that. Thanks, Deepak. In the meantime, you can use Q&A box. Okay, so let me begin first from a regulatory standpoint, Nikhil. And when I look at FRM framework, which my understanding is within overall that ERM framework that we talk about. So what's really the regulatory guidelines? We will come to the topic. We'll come to specifics on currency, commodity, interest rates, but just share some thoughts on the regulatory guidelines.
Yeah, so the Maulik, the regulatory guidelines, as you would be aware, are being it's continuously evolving. And I'll say that we are moving towards best practice in that, and something which is really required in today's environment. So we started off with, of course, first the forming of the risk management committee, then defining who should be sitting on the risk management committee in terms of majority of the board of directors, at least one independent director, then defining even at what frequency the risk management committee meets. And all of this was going towards ensuring that each of the corporate kind of has those practices ingrained in them, because it is very important to continuously look at risk. As we went along, the areas which are covered by this committee is increasing. Today, the risk management committee even looks at, say, the business continuity plan, the cyber security risks, ESG related risks. So it has gone much beyond just financial risks. But financial risks continue to be a very important element of it. And that is something which I think is a topic for today's discussion. But
Yeah.
risk management per se, regulatorily, is a very wide subject, and rightly so. So it involves reporting into the annual report today, laying down what are the risk management practices that the company follows. And it covers all aspects, right from identification of risk, assessment of risk, what are the mitigation measures, and what is the status today, and the reporting framework that you're going to have for this. So it's a very wide subject, and it's something which is really interesting. And I think every corporate and every finance professional needs
Hmm.
to kind of be up to date on what's the current practice that is there. So that's about the
Which
regulatory
are the
aspect.
companies which are
And
covered? I mean, the eligibility, which all, because not every companies are covered under the framework, right? Risk management.
I would say the first difference that we need to bring about is not do it because regulators want us to. We
Yeah.
should do it because every business should have it.
Well said. Well said. Well said. Yeah. Yeah. So one is of course the regulatory compulsions. I think I think top a few companies which are the
Yeah,
listed.
so regulatorily it will always be for listed companies. LODR will define one part, then you will have unlisted companies for which something different. But I would say that a risk management practice is a good practice to have,
Absolutely.
and one should take it seriously because a simple example I'll give is the business continuity plan. I
Hmm.
think if one had that in place in 2020, when we were hit by COVID, one knows where to go to, whereas people were struggling as to how we are going to struggle. So today we have a business continuity plan for every business line that we have. So
Sure.
every
Sure.
function that we have. And that's why it is critical that we keep on looking at these practices and try to see that we have those policies, practices in place,
Yeah.
whether a regulator wants it or not.
Yeah, absolutely. So one thing which all of you participants can rest assured is that Nikhil will definitely speak from his experience, and you will have some of the real life case studies. But at the same time, whatever he shares, these are all personal views. It does not represent the company that he works for. So that's one disclaimer I would share. So
That is
coming,
very important, and therefore I can be blunt.
yeah, absolutely. Yeah. So, so coming specifically to FRM framework, Nikhil, and it's one point is very well noted that it's all about business best practices. Risk management definitely forms a key part within financial risk management. Now, let me just sort of start with a policy approach. Now, you have worked probably the longest time of your career in M&M, automobile, and then now you are with an air conditioning company. While both are consumer facing, but definitely both has a different price point, different target segments, or maybe a common segment. When it comes to a risk management, how do you approach from a policy standpoint, whether the industry segment
Uh,
matters?
Yeah. So see, as I said, it's a mindset, and you need to kind of have a right policy in place, whether you are at a organization which has automotives as your products, or whether you are having, say, a refrigerator and a air conditioner as a product. So whatever it is, you need to risk management practices are unique to business, of course, but then within the general framework, most of the things remain common. So let's take an example where if you are going to look at currency risk,
Hmm.
you are going to evaluate the currency risk, whether it's a large organization or whether it's a medium scale organization or whether it's a small unit. The
Hmm.
only difference that will come is to see whether what is the whether I'm an exporter, whether I'm an importer, and what are the calls that I need to take. So that comes later. First, let us look at the policies. So I'll say the policies also need to be kind of designed for the company that you are operating in. There is no one size fits all. The policy will be different if you are working in an automotive industry where you may be an exporter, will be a different when you are facing an industry like today I am in terms of cooling industry where you will largely be an importer. That said, let me say that how one has to look at it. Even when I was at M&M or the earlier company, if you, when I say I was an exporter, that was direct. If I look at the indirect way, that is including the exposure of my vendors, I'll become an importer. So how does your policy kind of cover not only direct exposures but even indirect exposures? And there are different ways to manage indirect exposures. There are different ways to manage direct exposures. So your policies should try to cover all of these aspects. Look at what is your direct, what is your indirect exposure, what is immediate requirement in terms of short-term cover, what is requirement in terms of long-term cover. Do you
Hmm.
have fixed time contracts, fixed price contracts? Do you have variable contracts and where you are exposed to currency risk every day? So all of these things will be unique to each business. And looking at those aspects, one needs to draw down the policy, what is applicable. So that's what I'll talk about, how one should go about doing one's policy.
Hmm.
You are an expert, and so you and Pankaj can also pitch in and probably counter this thought if you have any thoughts on this. But
Yeah.
that's what is my view.
So, Nikhil, I fully agree with you on that. Basically, it's a perspective which is very important. What we are trying to cover, what we are not trying to cover, what is direct, what is indirect, how I'm taking my supply system, how I'm taking my demand system into consideration when I'm preparing a policy. The interesting thing to note about your profile, in basically, when I look at you are a group CFO, you have got subsidiaries abroad, you have got risk in almost all the three segments, which are part of FRM, it's currencies, commodities, and interest rate. So whether your policy, with the policy which you follow, uh, take care of offshore, onshore risk, and in aggregate currency, commodities, and interest rates, is the robust enough to take care of everything? And what is your advice to the participants on this?
See, one as a group CFO, you have to look at consolidated. So you cannot say that I will only look at the risk of my parent company, which is listed. As I told you, you are exposed to the risk across each of your group companies, whether or not they are listed in their own right. So therefore, we have to look at take a view comprehensively at a group level. Having said that, as I said earlier, each company may have its own requirements. So that's something which you will have to, because one may be a project company where I may have a longer contracts, where my policy will be completely different from where I'm doing a short-term borrowings, or where I'm doing short-term currency exposures. There the policy will be different. So policy is horses for courses. Requirement of policy is uniform.
Hmm.
Okay. So I'm just extending the question further, Nikhil. And all these policies are being drafted, and all these policies are being executed also. How will you rank your stock performance vis-a-vis the implementation of these policies? And I would like to convey that also, that Nikhil, Blue Star, particularly in last post listing, it has given at least 4 times more than the Nifty returns. The stock has been done extremely well. Whether this is a due to a successful implementation of these policies, there is a business definitely. I'm 100% aware of that. But would participants would like to know that how this increases valuation, how this basically give a kind of a stability to EBITDA. Your thoughts?
So Pankaj, finance is a support service function. I'll say the share price is a function of how your business does. And fortunately, business has been doing well. There has been good demand. We know all that India story is playing out, and that is what we are in the, uh, I'll say, center of all of that, because we do projects which are linked to a lot of investments which are happening across India, whether it be in factories, data centers, all of that. We are there for long-term projects. We are there into the cooling, where there is a lot of demand for refrigerated commercial air conditioners. So the business is doing by itself very good. We have had very good quarters in the past, and that is translated into better performance on the stock exchange. Of course, as a finance people, as a finance team, our role is what is important is that we support that function. We should ensure that the kind of the requirements, whether it be monetary, whether it be in terms of policies, as I said, all of that are well defined and in place, so that should there be any risk which is there, we should anticipate it and not do a proactive correction of what is there. So that's the critical part of a support function, to anticipate what's going to come and take it to the business and help business kind of face that in advance. That is will enable them to perform even better. So that's something which we concentrate on. That's something which we focus on. And if we can support business and they can grow and they can help the shareholder value grow, I think we have achieved our purpose.
Yeah.
Thank you. Thanks, Nikhil, for
So
answering this.
in one word, so Nikhil has been very candid, but in a way, you can definitely establish a linkage between some of the good practices and maybe the valuation of the multiples that a market will give. Naturally, because end of it, what we see as a result in our output is some factor of multiple things, whereas this also forms a critical part. And he will very nicely say a support function. But in some areas, for sure, he has been driving some of it, and that's contributing to the both profitability and a valuation piece. So I think that's a critical. Well, probably I'm sort of imposing my view on what Nikhil said. But I think that said, one comment from Deepak Kaku. This is related to the earlier comment between the subsidiary and the parent company, wherein says one should also look at the transfer pricing perspective as well of parent company as well as subsidiary which is incorporated outside India. And point well taken, Deepak. And thanks for
See, transfer pricing again, Deepak, point well taken. But at the moment on this forum, what I'm looking at is in terms of shareholder value. Transfer pricing is regulations. You need to follow for tax purposes. You need to follow for having a right practice in terms of arm's length and everything. But as a business, we should look at end to end. And end-to-end profitability is what will ultimately matter for the shareholder when we have to value that business. So we should follow compliance, we should follow regulations, we should do the right things, but ultimately monitor end-to-end. Because if end-to-end, if you're not making money, then you're not adding to the shareholder value.
Yeah, well said, Nikhil, and well highlighted, Deepak. Now my next set of questions, Nikhil, what I'm going to now do is I'm just picking up three different bucket: the currency, commodity, and interest rates. And separately, we'll take your views and Pankaj view as well, especially on the interest rate markets and the market intelligence. So let me now start with the currency, and I will give you my last probably 10 years of being in the consulting space. This is always a dilemma. What to hedge, how much to hedge, should you really manage first, should you really identify an exposure at a granular level, which means let's say at the time of raising a purchase order or a sales order, opening an LC, etc., or it can be part of the annual plan, or it can be planned part of the quarterly resetting, or if you are in a project company, it could be like 1 year, 2 year when you sign the agreement. So there are a number of business dynamics, and at the same time there are multiple approach to so-called currency risk. So the key answer is how much to hedge, when to hedge, What's your experience in managing this piece of the risk?
So let me start off on what are the basic hygiene things that you need to have if you have to hedge. I think one first thing is that one needs to have a plan. One needs to have a budget, because unless you have a budget, you don't know what you are going to hedge, and then what is the direction that you are going to take. See, when you do a budgeting, it is very important to factor in things like what are the exchange rate assumptions that you have given to various businesses to factor in their plan. What are the commodity assumptions that you have given to various businesses to factor in their plan? Of course, it is going to be forward looking. No one can hold to what it is. It's going to move. The environment around us is volatile, but at least there is to be a direction, and that is something which is a starting point. So if any organization has done a budget or an annual business plan, which is based on a particular level of exchange rate assumption or a commodity assumption or an interest rate assumption, you know as to what is it that you are trying to protect when you are doing to go a hedge. So again, hedging is a far larger topic, so will elaborate as we go along. But the important thing is that if I know what is the assumption, I know what I need to hedge. Suppose, just take an example, we are sitting in the month of January. If any organization today is drawing up an annual business plan for the period April 24 to March 25, they start the assumption on, and basis whatever research we have done with various banks, having predicted what the rupee will be, plus your in-house study, and plus experts like you giving views on where the currency will be, you give a particular rate to the business. Now, the first thing that I need to do as a finance guy, as I said, is to ensure to support the business to achieve that. Which means that if there is an assumption of say 84, okay, and I have a large variety of imports happening. Okay, tomorrow if rupee has to move to 87, I have exposed the business to a risk. Okay, same thing if I have to look at it as an exporter. If I have taken an assumption of an 84 or 85 and rupee has to come to 81, I have exposed the company to risk. Now, does that mean that am I going to go out and do all out hedging? No, that's not the answer for doing it. The answer will be to do a continuous assessment of where we are, what's the environment, what's the risk, where we are heading, what's how to kind of protect the business from what they had planned, and to do that, what's the best instrument to hedge. So therefore, I said it's a larger topic, because if you are looking at, at sometimes you may have to do it by way of options, and sometimes you may have to do by way of simple forwards. So it's a multiple way of deciding how to go about doing it. But the critical thing will be first to protect your business from their assumptions, whatever they have done. And that there the hedge plays a very, very important role. If you don't have a plan, I'll ask you a simple question. What are you hedging, and for whom and for what? Then you are playing a dart. You're just trying to play a fast one to say that I will go out and hedge. But what are you protecting? And you don't know what you are protecting. The business can tomorrow come and ask you, why did you hedge? Then it's your view that you decided to hedge. Whereas today the view is that I'm protecting the business from the ABP, and that's why I have gone out and hedged.
So, whether the AOP, the annual operating plan itself, is a good enough, it can be a good enough start point. But typically, and I can also again share from the experience, generally when you talk about an annual plan, and if in the month of January, if I have to project, now these are all some assumptions. Whereas the business will move on quarter. There are some of the businesses like yours, or even in automobile, there is a price resetting. So whatever I may have even assumed as an exchange rate at the start of the financial year may not really be relevant when it comes to actually delivering the value from a treasury desk. How do you really match this two? Because AOP is somewhere in January, but my price setting can happen in April, every quarter beginning. How do you match this two?
That is where the policy becomes very important, as to how much you are going to hedge and why. So unless, I would say that my view, unless you have a long-term contract with a fixed price, you should not go out and do a long-term hedge. I will never go out and do a long-term hedge, because then I will be exposing my company to a risk, unless there is an underlying which supports that.
Hmm.
So when there is no underlying, and like you said, I may have every quarter, I will have to take it by the quarter when it comes and take a decision for that quarter. I need to have a policy which will allow me to do a layered hedging. When I say a layered hedging, it would mean that I would today, even though I know that okay, the rupee is well within my AVP target, I won't go out and do 100%. I will go out and do maybe 20%. Okay, of maybe a little larger of the depending on what I want. If I'm an importer, I'm getting a good rate today. I may do some amount, and there is a view that the rupee may depreciate going forward. I will try to layer it in a way that I have say 20% a little forward for 6 months from now, maybe the 10% below that, 5% nearer, because I know that we are currently in what range. So that's how I will try to cover if I'm an importer. Same way at an exporter, if I'm going to get a good premium, I know that I have good value today. I will try to see how much I can do it for a full 1 year period, but not more than 20% to 25%. Try to do every month an assessment of how much more I need to hedge. So that's how one has to go about doing it. It's not something where I just kind of uh, pull a switch and say that it's 100% or it's zero.
Hmm.
It's a regular monthly assessment which has to be done, and therefore it's very important to have a forex committee or a commodity steering committee which continuously evaluates the exposure, which evaluates what you are going to do in terms of hedging, and there is a healthy debate before
Hmm.
you take such decisions. It should not be an individual decision of a treasurer or an individual decision of a finance person. It has to be a well thought out, well discussed, well debated discussion between the business and the finance, with finance giving them a view and business giving them an kind of perspective of where the business is headed.
Let me extend this point further. How do you then measure the treasury performance? And I'll just give you a perspective. January, I may give you a rate as an exporter, very safely conservative. Next year, 83 aayega. Matlab 83 ka range example. Whereas I also know that with the premium itself, today it can be much more than what the levels could be. And I may end up delivering as a treasury team much more than that. And then I'll claim my performance. So how do you really measure the performance?
Uh, there are two ways to look at this. One, what is your treasury function? Is it a profit center in your company or is it a cost center? When I say cost center, support function, as I said, not expected to make profit on its own. If it's a profit center, your decisions will be completely different. If it's a cost center, it's your profit decisions are going to be different. Let us start with the assumption that it's going to be a cost center, and it is a part of even when you're a profit center. I'd say that the first purpose of a treasury should be to protect the business, as I said. When I say that it has to protect the business, it means I need to do the hedging in a balanced way to ensure that I protect either the import cost or get a maximize out of the export revenues that I'm going to earn. One thing which I have kind of probably we would have discussed it sometime when we as friends would have discussed, but something which is very important for me and it's a very important learning is I look at hedge as a 6 month lease of life to business. Okay, so that's the way I look at it. Hedging cannot protect the business forever. So if the rupee from today from 83 has to go to 93, as an importer, my business has to face the reality of 93.
Absolutely.
Okay, at the most, I could have helped them by 6 months of hedging.
Yeah.
And after that, they are exposed to 93 because I will start hedging at those levels.
Yeah.
So your research and development function, your R&D function or your business has to always come to terms with reality.
Hmm.
So that's the function of a hedge or that's the function of a treasury function. So that's my primary purpose.
Hmm.
Now, once I have hedged and given the business some sort of comfort that they have a period within which they can play, they can decide, they can see how to go forward. Now, if I want to speculate, and when I say speculate, I strictly say speculate because once I have taken a hedge for a business, if I try to cancel and re-enter, I will say it's a treasury decision. It's
Hmm.
a speculation which a treasury is doing. Treasury is taking a view, rightly, wrongly. Treasury is taking a view. You can make a profit, you can make a loss. When you do that, it should be entirely to the account of treasury, and
Hmm.
business should not be loaded with it. While
Hmm.
when you take the first hedge, it should be the business which will take the profit or loss from that, because you are giving a business a hedge to function and they cannot say that I will only take it when it benefits me, and if it doesn't benefit me, it's yours. So that's not the way it is. It can't be heads I win, tails you lose.
Yeah.
It has to be a clear understanding where my first hedge is a business hedge. Any
Hmm.
further hedges which I do in terms of view hedge based hedging, or any view hedge if I take which is purely view based, which is not based on underlying, it's a treasury call, and those profit or losses should be to the account of treasury.
Yeah, I think you have actually answered my second question, which was a follow-up on, once I take the hedge, what would you then recommend? Can I do an active hedging, or it is a merit to the position? And like the message is very clear that the first is the business hedge, and then whatever you do is a treasury, and then hold the treasury accountable for those subsequent cancellations and the rebooking. So that's
Exactly.
very important message. And I think you said it. The other piece was very, very relevant. I think in the entire way of looking at the hedging, it's a 6 months lifeline. Then the business has to face the reality. Be it an importer, if you are moving from an 83 to 93, or even an exporter, if you are tomorrow facing the regime of say 70s or 73s, then your business has to adapt to the new reality. So I think that's a very strong point that you mentioned. I only have one difference, and that's something which the point that you earlier mentioned about the long-term contract. Now, today I may have as an IT or service exports or many other even clinical research, some of the clients that we have been, serving in some of this exporter, and I'm talking about more of an exporter, not an importer, which has a long-term commitment, and the price is fixed for let's say 2-3 years, and that's a committed, and we have a very strong predictability on the revenues, etc., etc. Would you then recommend that yes, we should then go for a long-term hedging, and what are the pros and cons?
Yeah, so as I told you, if suppose take an example of a software company or any other where you have long-term contracts. Now, if you have an underlying long-term contract, okay, at a fixed rate, then you have a particular contribution to which you are working. So there has to be a contribution basis which you have arrived at that price. So that's what
Hmm.
I said. And when we referred to the earlier annual business plan, this is slightly different. It's a 3-year plan, maybe because you have a 3-year contract on hand. Your primary role will be to go and protect that contribution.
Hmm.
Okay, no way can I expose the business to risk. Now, whether you can maximize the profit, that's the question which see, whenever you say that I will try to maximize the profit, you are looking at one way. You can also go and minimize it. Okay,
Hmm.
that because if the rupee goes other way around and you have left a position open, then you can end up reducing the profit.
Yeah.
So it is clearly a company call. What's the company philosophy? What's the company way of functioning? I come from a school of thought where I will say that you protect what was decided, stay with it.
Hmm.
You are not here to contribute to the business by making profits on forex
Hmm. Hmm.
unless you do it as a treasury function. And then that's a philosophy which the company should have. You should be a profit center. Otherwise, you are no business to play around with the business revenues by taking any different view on hedging. So
Sure.
go out and do a 3-year hedge if you have a 3-year contract with the underlying price which is fixed. If it is variable, you have to go as per the variability and you should protect what is fixed and leave open whatever is variable.
Pankaj, I'm going to loop you in into this debate because we all have dealt with this. Typically, when you end up having a long-term FX hedge, it creates a volatility on the P&L. I mean, unless you then add up the hedge accounting and all. So, Pankaj, just a question to you: how do you then manage this trade-off?
So definitely, this is the question which we deal every day, day in day out with all our long-term exporters. But at this point of a time, we pre-communicate to the team or pre-communicate to the client saying that was these are the long-term contracts. We are trying to protect this value, but at the same point of time, we are allocating some of the risk tools, in a sense, in a risk capital, I would use the word. If my mark to market on these kind of a forwards goes by certain percentage, I will take off the hedge at that point of a time, and then we will relook at it, because at the
Hmm.
same point of time these long term exporters also have a constraint on their credit lines with the bankers and all. and
Yeah.
uh, and these are long term contracts are also become some point of a time that they become a contingent, due to some certain terms and conditions. They also fail because of somebody else can price it better, can price it cheaper. So that need to be taken care of.
So I
Can
think
I ask one question, Nikhil? Okay, you were saying something, Malik.
Just to reflect on your thoughts, I think you said two things important. One is the credit lines. That also governs a part of the long-term effects, because then naturally when you have a negative M2M, so assuming that you have hedged a year back at 73 as an exporter and today at 83, you end up paying M2M losses to your banks. So that's a function of that. Plus, second thing is the competitive advantage or a disadvantage, as the case
And
may be.
contract contingency of the contract also comes into picture. So we
Yeah,
actively
and
look at
even if there is a remotest possibility of canceling or revisiting those terms, then yes, you end up just sort of converting your hedges into a speculative position. So that's, I think, another piece.
See, that's what I said. It should be a fixed price. It should not allow the exit. If you're saying if there is an exit clause where you can come out of the contract, then hedging long term is not a solution, because
Yeah,
then you will end up being less competitive as compared to whatever your peers are. So the only if it is a fixed price contract, which is kind of with no exit clause, then you
sure.
can go and take a long term contract.
Sure. Perfect. Pankaj, you have a question? Just before that, I have a flash on by Tushar Jagtap. Tushar, I will pick up your questions on the interest rate section. I think that's relevant and perfectly well highlighted point. Allow me some time.
Actually, I wanted to ask that question at this point of time because that has
Okay.
got a more currency element than the interest rate
Okay.
element.
So you go ahead. So you can
So
place.
Nikhil, whenever we interact with the corporates which have got a long-term loans and they are exporters, that this question keep popping in is basically whether exports are a natural hedge against these ECBs. And we will pick your brain on this. We have our set of view and which we keep communicating to the clients, but I definitely would like to
And
have
by the
your
way, I'm
view.
laughing because I know Nikhil's answer because I've interacted with him earlier on the same subject. But
So
yeah,
let the entire all participant group have that
yeah,
view.
Yeah, so sure. So I'll give you my view. Of course, it's debatable, and on certain places, even in my earlier company, on one or two boards also where I was, it was actually a confrontation with my co-colleague who was on the board. But I will still hold my view. And if you ask me, financing and business should never be merged. Okay, these two are independent things. What are you doing as a finance guy when you say that export is a natural hedge to my borrowing? Just try to dissect it. What have you done? You have a borrowing, okay, where you have a currency risk. You are not taking a hedge because you have an export and you are saying that I will use those dollars or euros or whatever to repay the loan over here. Now, take these two as two independent transactions. Let's take a loan first. When I have taken a loan, how do I take a decision of where to borrow, in which market to borrow? I need to have a benchmark. So when I'm taking a foreign currency loan, I am always eligible even for a domestic loan, be it short-term market or be it in long-term market. If I do not take a hedge, okay, and I leave it open and I say that now this loan is far cheaper to my rupee market loan, I think it's just being, I don't know what word to use, but it is trying to cover up for your decisions to say that today I want to kind of borrow long term or foreign currency, and therefore I'm trying to look at it that way. And then I go out and say that but I have exports. So that's going to cover for this. Now, if these two are independent transaction, you could have hedged the rupee loan, a foreign currency loan, and you could have taken a forward premium on your exports. A forward premium on your exports means your realization would have been much better. Your contribution to the business would have been better. Your operating margins at business would have been better. And when they look at it in terms of their competition, they would stand out because they would have got that additional premium over there. Now, when you use that as a natural hedge, you have compromised that. You have compromised that premium, which was actually your business income. You have brought it to finance because you have to cover up for your open positions. So at the same time, if suppose, when you use that foreign currency, exports currency realization and use that to repay your loans, and at that point of time, you realize that that cost of loan is actually turning out to be 12% or 11%, when you could have borrowed a rupee loan at some 7% or 8% when you did this foreign currency loan. You have taken a very, I will say, a decision which is not accreting the shareholder value. You have actually taken away the value from the shareholder because you could have very well borrowed at 7% and at the same time got this premium for your exports.
absolutely.
So these two are clearly independent decisions. As a treasury person, I don't think you should mix the both. unless you are in a situation where you don't have an option to go out and borrow in the rupee market, you have kind of to the brim as far as your limits are concerned, and you have no choice. But I don't think we are discussing that type of company. Then the decisions are totally different. For a good operating company, these two are two independent decisions.
Yeah, yeah. And
you,
I will
Nikhil, for answering this in a detail. Yeah, Maulik.
And I will marry the concept with the way regulators and the investors look at it. And I think you highlighted a point that, the borrowing or how you finance your operations has to be distinct from how you manage your EBITDA margin. And very clearly, when I talk about an EBITDA, naturally interest is below the EBITDA. So my aim of business hedges are to protect EBITDA. And everything and anything
Yes,
that I
yes.
do, financing or interest cost saving, etc., is all below the EBITDA. So I think even you look at the
Exactly.
concept and the way it is being perceived by the investors or the regulators. Even in the regulatory guideline of January 2014, when the penalties on a UFC, they refer EBID, again interest before interest and debt. So all of that, I'm just saying the lens that is being used is very clearly the business hedges has to be distinct than your borrowing related. Yeah. So perfect. I want to switch gear to the commodity in the next few minutes. And I think Nikhil, both in M&M and in Blue Star, you have a fairly large commodity exposure. So one, of course, how important, significant that is, given the industry segment that you both, I mean, in the both companies that you operate in, and how are you hedging it in terms of the marketplace or the instruments? Just share your experience in this commodity hedging space. And we have a lot of clients who
So,
have that exposure.
so commodity is also just like, while there is a lot of focus on FX, I think every organization has much more larger exposure to commodities
Yeah.
because as a part of your material cost, commodities play a big role as to how your contribution margins are going to move, and again, how you will remain competitive in the market. So hence, commodity hedging is something which every organization should look at and try to have a policy for that too. Uh, how it impacts the businesses, if I have to look at, both the businesses that I worked in are very different. In the current business, my objective is to see how to make my end product more and more affordable. And if I have to do that, then every 200 rupees and 300 rupees saved is very important. From that angle, to ensure that I protect the commodity volatility and trying to see how to kind of again support the business by allowing them that flexibility to see how they can price their product in a competitive manner. I think commodity hedge plays a very major role.
Hmm.
Of course, we are at a very, I will say, beginning stage in that in the current organization, but of course, we will evolve as we go along. We were slightly better matured in the earlier organization where the exposures were even more higher. But again, over there also, it was a similar thing. Automotives have a great exposure to commodities, and therefore, if commodity hedging is done in an appropriate way, and particularly when we see volatility moving from copper moving from 7,700 to even 9,500 and 10,000, I think one has to see it in the way that it is 10 to 15% increase in a copper price will at least lead to 1 to 1.5% increase in your base material cost, which
Hmm.
means that 1% margin on your selling price is substantial when your turnover is in excess of 10,000 crores. So
Yeah.
that's how one has to look at it as to what's the exposure that I'm trying to hedge, what's the profitability that I'm trying to create. If I
Hmm.
can save 0.5% for a company which has a 20,000 crore turnover, I have added, that much 50 crores to the bottom line. So that's the way to look at it, and that's why hedging is very important. Of course, commodity space itself, I will say, is not very matured as far as we go because in India, if you see, one can go out and hedge on the local indices, but then there is not much depth over there. There is not much duration over there. You can go out and do an hedge for a 3 month or a 6 month period, maybe, but beyond that, the market will be very shallow.
Hmm.
Whereas if you go on an LME or you go with OTC in the international markets, with the bankers, I think you have a much more better way to hedge yourself and a little longer period you can take a view on. So I would suggest that if one has to hedge, then one should go out and do it either on LME or with the OTC banker abroad, so that you get a slightly longer view and you get a better price discovery.
So, as far as the regulatory access is concerned, every companies today can access the overseas market, right? There are no restrictions today?
There are no restrictions. You have to have proper policies. Again, you should define the key things. You should, again, as I said, have that hygiene factors in place, have the commodity steering committee to monitor it, have a proper defined policy as to when you are going to hedge, what is the basis on which you are going to hedge, define those rules, and then you can go out and do it.
And Pankaj, in terms of the accessing, you go to your banker, you go to the exchange members. I mean, how do you activate it? How do you get started on that?
So basically, Maulik, now the RBI has made very easier that anything you want to hedge, except some sectors and some products, you have to apply to the authorized dealer. Authorized dealer give you permission to hedge yourself. You go and access those markets. Now, it all depends how you are well placed to use exchange or OTC market. In OTC market, you get a very good customized products like average rate products, and then you can pick up the quantity and all those things. In exchange, these are standardized. So same forward versus futures. Banks are also gives a good customized products. Nikhil, we face generally one challenge in case of a commodity hedging is basically to convince the clients to use backwardation curve and contango curve. There's some point of time they are very hesitant. If I'm a seller, why I will be selling in a backwardation? If I'm a buyer, why I should be buying in a contango market by paying such much of premium? How to convince those things? We put up a historical data and all those things, but generally people are against seller against the backwardation, buyers against the contango market.
Yeah, Isa, I'll just say, Pankaj, probably, therefore, you have to kind of drive home the point that you are protecting their planned profit. Okay, rather than explaining that you are into either backwardation or contango, you should say that what is your plan
What
and
is your
I'm
objective?
protecting your planned profit. Do you want that or not? Or do you want to expose yourself to the planned profit? That's where I think the first, any business house will and I'm saying this out of experience. Whenever I have faced this situation and I have sat with the business person and I tried to explain him how I can help add value by protecting him. All of it will look short term, but all of their KRAs are linked to business profits. So the moment they know that their profit is getting protected, they will be with you.
Okay, got you.
But one thing that I can tell you, Nikhil, from the experience, and this is again, I was talking to one of the CFO of a large company, commodity driven. They said currency volatility is hardly anything. I mean, 3, 4, 5% at best. Commodity volatility is huge. In spite of that, it is not really institutionalized when it comes to commodity risk management, because somewhere, whether it is a CEO or the owner, they feel probably commodity is their game. I mean, they want to, if it is a copper, then they would know better. I mean, why would I don't know what the mindset is, but when it comes to professionalizing or institutionalizing the commodity risk management, and you also said we haven't really seen the matured commodity risk management market in India, at least. And maybe it's again, I mean, the market is not
So, more experience, I'll just tell you whether in FX or in commodity. Uh, so FX was risks management was always there in both the organizations. But I had the privilege of starting commodity in both the organizations. So from experience, I can tell you, even in a large organization that I was earlier, it was not easy to set up a commodity desk. But but the key differentiator is to take business along. See, it is not a treasury decision. It is not something which I want to do. It's something which we have to do. And that's what we have to take the person along with you. So I'm just saying that leave it to a commodity steering committee where a business will take a call. You support, you try to give him ideas, you try to see how, if he's taking a rash or irrational decision, how to stop it, but let him take that decision. It will evolve, but over a period, it will be like you will have a proper desk which is running, and over a period, they understand better that it's better left to you. I'll tell you, it started with where the business used to take a call in my earlier company, and by the time I had left, it was he used to just come and say that you tell me what to do. And I think that's where we have to reach. So we should not start with saying that I will take calls for you. Start with saying you take calls, I'm there to support you. And over a period, they understand who is in the market, who understands the movement better. And therefore, they will say that you take the calls and I will support you. So
Yeah.
the roles will change over a period.
Fantastic. So I think that's a real case of a transformation. Instead of I wanting to do it, let's together, make this process work, and then eventually the expertise will take over. I have two comments. One is Kundeep Thakkar, who commented on your earlier comment about the export being used as a natural hedge for borrowing, and he complimented you for that. So that is Kundeep Thakkar. Then there is a comment by JK, and I'll read out. There could be a question as well. Let me read it out. Regulator has allowed non-retail customers to hedge in NDF market through GIFT City banks. But in reality, has this really worked? I mean, have the banks been offering this facility seamlessly? If so, are there any minimum volume limits, etc.? So that's one. And the second point, for companies with long-term contracts like IT sector for receivables, up to what tenor should the RMP ideally allow for hedging? Any one of you can pick up and respond. Yeah.
So I'll tell the second one first. I missed the first start of the question, therefore I'm just leaving it. But the second one, see, it's very clearly, as I said, depends on your underlying contract. If the underlying contract has exit clause after 1 year, 1 year is your period. If the underlying contract has no exit clause, the contract period is your hedge period. So that's how one has to take a call. Is my view again. You and Pankaj can put in. You people are more experts. You deal with much more different types of customers. So you probably can give a better view on this than I can.
Yeah, I mean, I also agree. Coming back to the same trade-off between your long-term, though it is very certain, very predictable, but given the longevity, given the sheer time factor, where it is about more than 1 year, you will always add on other factors which needs to be balanced, because there is other factors, which is M2M negative, rating, bank line, all of that, PNL volatility, etc., etc. So I think that's where the point is. Pankaj, the first point, you want to comment?
So I think need to interact with the bankers to figure out whether they are started offering hedging products to non-retail guys. The non-retail guys, according to the recent circular, have been defined as companies which have got more than 500 crores net worth and 1,000 crores turnover. We'll figure it out. JK, I will figure it out and we'll come back and discuss on this. Second point, Nikhil, and you have already replied.
Yeah. In the next few minutes, so one is we covered broadly on the regulator, the policy perspective, which are common to all the FRM, all the three financial risks. Then we double down on the currency and the commodity. And I want to then come to now interest rates. But before I come to interest rates, just taking both your views on the market intelligence, I'll start with Pankaj. You, given the year that began with expectation of the rate cut 2024, and market is discounting more than 6 rate cuts, whereas FOMC has indicated 3 rate cuts. What's your take on that? And then I want to sort of talk about how do you then manage interest rate risk in the given scenario, both domestic and international. Yeah, Pankaj.
So what I will try to cover here is basically what is the global outlook, and then we will look into India specific. According to me, the tightening has been worldwide over. So that period of basically some 25 basis more, it has gone. That is off the cuff. The markets have really started pricing a rate cuts, and market have gone extra basically gung about the rate cuts. I have my doubts. I don't think so. US will be able to cut more than 100 basis point. Even FOMC have indicated a 25 into 3, kind of a 75. And that's not a FOMC. That's basically a dot plot. We are interpreting a dot plot which has been put up by the FOMC members. In the coming days, maybe couple of weeks and maybe 1 or 2 months, we will see a corrective mode of yields, maybe continue to move higher. It's coming because of two things. The down move has been very, very sharp. That's one. Second is we are seeing a supply blockages again to the Red Sea and all those concerns. So that will be short-lived, but that will be there. And overall perspective on the interest rates would be that the rate cuts will be coming, but it will be coming on a far off. So short-term inflation going higher, we would be looking at basically some corrective moves. Anything between 15 to 25 basis higher from these levels in a 10-year, or maybe on a 20, 25, 30 basis higher in a 5-year would be a good yield pickup things there. We should be looking to invest, or maybe somebody who has converted into a fixed rate, they should be moved back to the floating rate. So that's the point I will try to. In India, I think rate cuts would be, it will take a longer time. It will take much, much longer time. 2, 3 reasons. One is basically Our inflation has been anchored, and it will be stay in the range of a 4 to 6%, or maybe it will not dip below that. But due to a capital starved country, we would like to have some more capital to build our reserves and to build more exigencies. We will keep our inflation, we will keep interest rates higher. I don't see interest rate coming in India before October. So maybe up to October, market will be talking about 10-year yield will become between 725 to 735, very, very attractive to pull in. If you look at the borrowing perspective, we should start looking at the borrowing floating. We should not be, even somebody has got a fixed rate borrowing, their instruments are available to convert that into a floating rate. Anything which is beyond 2.5, 3 years, definitely they should look to convert into a floating. That's my.
Got it. Got it, Pankaj. Now, before I move to Nikhil, just Nikhil, I want to take your permission. Are you okay with an extension of another 10 minutes? Or you
Yeah,
have,
fine.
is that okay? Because
Yeah.
I mean, I tried covering I have a lot of things to cover. I tried covering it in a schedule 1 hour, but I have 2, 3 other points. I just looked at the notes, the digital roadmap, that, something that I really want to hear you or your views, and a few other points. So 10 minutes we will extend. I'll try and see if we can cover
Sure.
more things. Yes.
Sure.
Specifically for you, Nikhil, on the interest rates, I mean, how are you strategizing, whether it is a borrowing program or it is an investment of a surplus funds? I mean, what's your take, and how are you aspect?
So, see, if I have to take a decision today, I would say that I will not go for a long-term fixed rate borrowing. As Pankaj also said, it will have to be a floating rate because there is a clear view that the interest rates will come down. Having said that, I would like to kind of give as you said, some real instances which I have faced in life. And that is just a couple of years back, when we were just having a low interest rate scenario. When for a long period of time, the rates were not going up. Uh, I still remember where in US, I had to take a decision for a US company, and the interest cost was something like 0.4, 0.5%. And the bankers were after me, ki you hedge before the rate goes up. Because if it starts going up, then you'll look like a fool that why you did not hedge long term at that point. Luckily, being conservative that I am, I did not take a whole out decision. I just did some 10%, 20%, and the interest rates came down even further after that. So when it was not expected, and it went below 2.25 and zero point 0.2 also. And then when it started going up, it suddenly started going up. And by that time, of course, I had moved out and therefore I was not exposed to it. The point is, see, when it comes to interest rate view, it is you against me. So I'll just say that, it's purely a view. There are a lot of factors affecting it. There are a lot of the environmental factors which affect it. Suddenly something happens in the global space and you see everything turning upside down. The things will get costly. Inflation will again start not going down as expected. Interest rate will be on hold. So one has to take. I will just say that you have to be dynamic. You have to be dynamic. If you and I can relate to our earlier common boss, in earlier company, you used to say that it's not the change, but the speed of change. I think
Yeah.
the speed of change is totally different, and it's become even more kind of speedier now. So you don't have the luxury of where you can take a decision and rest on it. I
Mm,
think you have to be dynamic. You have to keep on keeping that window open to say that if things don't go the way I want to,
mm,
what's my plan B? And
yeah,
that has to be there. For every time you take a decision, have a plan B. Okay,
yeah,
because it may be a little suboptimal, but it will still help you kind of wriggle out of what you have got into. That's the only way to function in today's world.
yeah, yeah. Great, great.
Well
Will,
said.
will the approach to the interest rate curve or the interest rate risk management be different if you are borrowing or if you are managing a liquid funds? Or it is agnostic, it is irrespective of whether you are borrower or investor?
It will be different because the durations are different. See, when I invest, again, primarily my job is to keep liquidity available for businesses.
Hmm.
So I am not going to invest for a 2 year, 3 year period unless it's a core surplus.
Hmm.
So if it's a core surplus, I have that luxury. Otherwise, my liquidity has to be available always. So I'll always look at short-term investments. Whereas when I'm doing a borrowing, it may be a mix of long-term and short-term. Therefore, both cannot be compared strictly. Both you will have to take an independent call depending on what's the current near-term scenario which is there, uh, and decide how to kind of either invest or borrow.
Yeah. Yeah. Okay. Nikhil, on the digital roadmap now, Treasury, all of us know we have been, I mean, entire organization will be on an ERP, SAP, Oracle, or best of the platform, but maybe Treasury will continue to be on a Excel-driven model. But a lot of innovations have already started happening. There are technology, the fintech solutions. So now I'm specifically talking about currency, commodity, interest rate, risk management space. How do you see this role of technology playing out?
I personally again feel that technology is very important and very critical.
Hmm.
And we have to move away from Excel-based treasury. It has been the comfort of we as treasurers that we want to work on Excel.
Hmm.
But if I look at treasury, I will again say that look at it end to end. So when I say digitization, it doesn't mean that at the end point digitization. Look at it end to end. Okay, it will be even your exposure mapping.
Hmm.
Can your exposure mapping get better with your digitization tools?
Hmm.
Then it comes to forecasting. Can I use AI in a better way to forecast better?
Hmm.
Can I use leverage ML in a way that machine learning will help me kind of uh, see what are the various variables which are there, which are into play, how they are moving around, and marry that with the AI intelligence to see how I can use it for my businesses. So these are the tools which are coming up. These are the tools which are kind of there are various products which are there. It's very early. I know it's not something which, while many people say that if you ask me that blockchain has been there for a long time. So I always say that blockchain is like Africa. It's a promise which has never delivered. So, so similarly, I'll say digitization is very critical,
Hmm.
but how you use it, where you use it, and you need to have a much wider perspective. So
Hmm.
start with even saying that can I use digitalization tools for mapping my risk, for
Hmm.
mapping my exposures, which is a real thing, which is today you are work. Yes, it may not be where you still call and ask, "Aaj kitna paisa invest karna hai?" You have moved away from that. But still, there is a someone somewhere taking a call on what's the cash available, what's the thing. If you ask me, everything is whether it's on system driven, whether I get it at the kind of one point in time, what is it today, what is it tomorrow, are the movements being tracked, are the reconciliations happening online? No, it is not. So look at it at an end to end basis, do the mapping first, then move to predictions and how you have to do in terms of leveraging AI.
Got it. And I will come to the last question for you, Nikhil. And this is more personal than a professional, but yes, very much relevant to all the professionals. I think you have been part of the larger setup at a very senior positions, almost longest of your career spent in M&M. And now you are with a company which is like you are in a very key position of group CFO, and you have seen a transition, in terms of sort of, moving, taking that call after almost 20 years, then moving on and taking the senior position. Uh, you have a lot of learnings. What's your advice or a key things that you would want to share with the participants, and especially for a professional like us, for many who are attending or who will eventually be seeing your video at some stage?
I'll just say that every day morning when you get up, you should feel like going to office and doing something different. And the day you feel that you are not doing something different, it's time to move on. That's the way I look at the role which I have been doing over the years. I have kind of always wanting to do something different, wanting to do something new, wanting to learn something new. And as long as that kind of thing keeps coming your way, you enjoy doing your job. That doesn't mean that when you move from one job to other that you always have to stop enjoying. It's not that way. It's the thing of whether you can do something more. The way I took this decision, it was a purely personal decision. And it's not easy. It's a very difficult decision when you move away from an organization after 28 years. The sheer
True.
comfort zone which you are in
Yeah.
is different. It's completely different. And when you come out and say that I now to start from scratch and prove yourself all over again,
Hmm.
it is a different kind of a challenge. But then one should have that life when you so when you move to any other organization at a very at a different level, at a higher level, I think it's a very useful book. It gives you certain key basics, mistakes which you should not do. So that's very important. And those are like, don't go out to any new organization and try to say that in the older organization, this is better, that is better. Every organization has its strengths. So look at and appreciate the strengths of the organization you are going into. Try to bring in the best practices in a very amicable way. Over a period of time, don't try to change things overnight. You have to give time to everyone, I think, to do that. Go for some quick gains, but at the same time, have a long-term plan. So you should have basic things in place, and then of course, it's your luck. You need to be amongst. I've been lucky that I've been amongst the good people, whether it was an earlier job or whether it's a current job. I think when people around you are good, you always tend to enjoy your job.
And good people always attract good people. So that's been really a wonderful session. Before everyone goes out, I just have one last request. And before even I say thanks to Nikhil, there is a poll which is being arranged. Just a quick 30 seconds. So if you're ready, Kushi, just flash it. And you all can just quickly go through this. It will help us as well, to frame the entire format of the sessions. You can be very quick. You can keep moving on. How many questions you have, Kushi? So will that be your next flash?
So the first 90 days written by Michael Watkins, right?
Yes. Yes.
So I'm just filling in. The next question, please.
Yeah, we're just about to complete and you have a next question. It's already flashed. It's all done.
Only one question came.
No, so we continue. Okay. Okay. No, we will just complete the session. Already 6:10. Okay. So I'm not sure whether this poll thing has really worked out well, but nevertheless, we'll be more efficient next time. But yes, Nikhil, indeed a fabulous. I don't know about others, but I thoroughly enjoyed interacting. For me, it was like a free-flowing conversations. Yeah, some questions are still flashing on. Anyone who was still around, please keep posting your response. And in the meantime, I'll really thank Nikhil. It was indeed, and you've been very candid in responding to your questions. So thanks really, and I'm sure it was valuable to almost all of them. And thank you, Pankaj, as well for partnering with me and at the same time contributing to your the entire deliberations through your intelligence. So really, indeed, thanks both of you. Thank you, Khushi, Harshul, everyone who has worked in the back end to make this session work. Yeah, Nikhil, anything you want to say?
Thank you, Almas. Thank you, Maulik, Pankaj, and everyone for having me here. It's always a pleasure, and keep enjoying discussing with you. So we'll continue our discussions over lunch, if not here.
Absolutely. Thank you so much.
Yes.
Pankaj,
Thank
anything
you.
from you?
No, thank you. Thanks a lot. Thanks for your time. And basically, since you're on a business trip in Dubai, and then also you have spent a good 90 minutes with us. Thanks a lot for that. Thank you, Nikhil.
Thank you. Thank you. It's a pleasure. Yeah.
Thank you. Thank you everyone for
you.
staying along
Yeah.
and indeed appreciate your contribution in this poll as well. Oh, it's already out. So yeah, thanks. Thanks so much.
Thank you.
Bye.